Okay, you guys, we're now going to take a look at exercise 16-1 on page 973. We're dealing here with some, it's accounting for income taxes. We're going to calculate the income tax expense, which the corporation would deduct on their income statement. We'll also calculate income tax payable, which the corporation would show as a current liability on their financial statements, and it represents what they would actually owe the IRS that year. And then we'll, if the difference in taxable income and book income is created by a temporary difference, then we'll also end up with a deferred tax asset or a deferred tax liability. Now, they ask us, let's read through it first though. This is again on page 973, exercise 16-1. Alvis Corporation reports pre-tax accounting income or book income of $400,000. But due to a single temporary difference, taxable income is only $250,000. At the beginning of the year, no temporary differences existed. Okay, they say assuming a tax rate of 35%, what will be Alvis's net income? So really there what they're wanting us to do is calculate income tax expense, deduct it from book income or pre-tax accounting income, and that'll bring us to net income. Then on number 2, what will Alvis report in the balance sheet pertaining to income taxes? Well, they're wanting to know about the deferred tax asset or liability and income tax payable. So to me, you guys, the best way to answer number 1 and number 2 is to do the journal entry. So let's assume they don't ask for the journal entry, but I think it helps to understand these if you see the journal entry. It makes it so much easier. So we'll start with it, and we'll assume that their fiscal year is the calendar year. So we'll just say December 31, and we're going to debit income tax expense. Now it's calculated, if you'll remember from your notes, by taking pre-tax accounting income or book income, which in this case is $400,000, minus any permanent differences. We don't have permanent differences here, so then it's not always minus permanent differences. It could be added back. We want to take out the effect of any permanent differences and then multiply by the tax rate. Here there are no permanent differences, so we'll just multiply by the tax rate of 35%. That gives us income tax expense of $140,000. Now let's credit income tax payable. And now it's calculated by taking taxable income times the tax rate. Taxable income is $250,000 times the tax rate of 35%. Gives us income tax payable of $87,500. Now, if you get to this point in the entry, we need more on the credit side to balance the entry. So we have what's called a deferred tax liability for the difference, $140,000 minus $87,500. So let's just assume that this temporary difference was created because we're able to take more depreciation expense on the tax return and less on the financial statements. You guys, over time, that's going to work itself out, right? But because we're able to take more expense on the tax return, taxes owed this year, $87,500, is less than what we're deducting on the financial statements for income tax expense. What we're doing really is delaying paying income taxes because we're able to take more depreciation this year on the tax return than we are on the books. Which is a good thing for us, right? When would you rather pay your taxes, today or sometime in the future? Well, you'd always pick sometime in the future. You want to put them off if you can, right? So this is kind of an odd situation where we would really prefer to have a deferred tax liability than an asset. Deferred tax liability means we're going to have to pay more taxes in the future, but it also tells me we were able to delay paying them. Deferred tax assets created when we pay more taxes today and less in the future. I don't want that. I don't want to pay more now to the IRS and less in the future. I want to pay less now, more in the future, right? You could, theoretically, you could die in the meantime, right? Okay, so this is kind of an interesting situation where you would prefer to have the liability on the books rather than the asset. Deferred tax liability means we were able to delay paying income taxes. Deferred tax asset means we're paying more today and less in the future. Okay, now let's take this to answer requirement 1. They want to know what would be the net income. Well, we would say pre-tax accounting income which was $400,000 less our income tax expense. You guys, this should show up on the bottom of your income statement. Our income tax expense is the $140,000, and that's going to give us net income for the difference. $260,000. Okay, requirement 2 asks, what will Alvis report in the balance sheet pertaining to income tax? What will Alvis report in the balance sheet pertaining to income taxes? Well, income tax payable would be reported as a current liability, and the deferred tax liability would be reported as a current or long-term liability depending upon when the temporary difference is going to reverse out. Okay, so income tax payable would be reported as a current liability, and the deferred tax liability would be reported either as a current or long-term liability, depending upon when the temporary difference will reverse. Okay, you guys, after working that one with me, you shouldn't have any trouble with your exercise 16-1 on Connect Plus. Good luck, and be in touch if you have questions. Thanks.